All right, we are live finally, and I have with me Andrew, old friend and colleague of mine, and yeah. So the idea of this live stream is basically to have a little bit of fireside chat regarding startup finance, and I can't think of any better fit person to cover this topic than Andrew. Um, do you wanna do a quick intro of your background to make sure people understand why one should listen to your thoughts here and why startup finance makes sense?
Sure. Yeah. Thanks, Seb. Appreciate you
My
having me
pleasure. It's an
on.
honor.
Sorry, can you hear me?
Yep.
Oh, great. So my name's Andrew. I have a background in finance strategy and operations. I have raised about 75 million in venture equity and debt capital at both the Series A and Series B stage. I started my career as a CPA, actually, at PricewaterhouseCoopers, auditing companies, making sure the numbers were right. First in a non-tech and then in a tech focus, moving from the East to West Coast. Worked on the Twitter IPO while I was there, and then left to join Stripe as the first finance hire right after the Series C, where I broadly built out the finance and people functions. Um, from there, I went to be the chief operating officer of Feather, which is a furniture subscription company, rethinking people's relationship with furniture. Very different business, of course. And I scaled the company from seed stage to 8-digit million revenue, 5 to 100 headcount, and built out the executive team there as well. Today, I spend my time advising and consulting with companies in the tech and blockchain space specifically, um, on various topics to include go-to-market and finance.
Awesome. And I guess the thanks for that introduction. I guess the sort of the red thread here is finance and operations. Is that a good summary?
Yeah, that's fair.
Do you do you feel like so we just for those tuning in, we just talked, had an internal workshop with some of the entrepreneurs and startups, and we went a little bit deeper on this topic. We looked at unit economics and liquidity analysis and all that stuff. But for the purpose of this fireside chat, could you share a little bit about your thoughts around general principles when it comes to startup finance and why anyone should care?
Definitely. So there are three things that I think matter from a startup finance perspective. The first thing is it relates to your number one job as a leader or a founder. That is, don't die. It is the most important thing to stay alive, because then you have a fighting chance at building your company, changing the world, making money, whatever your goals are. Um, Paul Graham from founder of Y Combinator has this great quote that says, "If you can just avoid dying, you can get rich." That sounds like a joke, but it's actually a pretty good description of what happens in a typical startup. And
Yep.
so I think that's the first principle, is like finance helps enable you to do your job to not die.
Yep. Uh, Andrew, there's something going on with your mic, I think.
Ah,
I have some sound.
can you hear me?
Yeah, yeah, but it's like a vibration going on. It disappeared.
Ah, okay. Well, there we go.
Now it came back.
Ah, interesting. Let me try this.
It disappeared.
Can you hear me?
Yep.
Okay, great. We will try that.
Awesome.
Okay, great. Number one job, don't die.
Yep.
So second is that finance is our ultimate scorecard. So by that I mean at the end of the day, all the effort that we put into building product, hiring people, acquiring customers, ultimately gets sort of summarized in a quantitative form in your financials and in the money that you burn. And so that's why investors are so focused on it, because it's a really great place to start and understand what's actually going on in a company. And your scorecard means the difference ultimately between a rocket ship or a ticking time bomb, because it reinforces the story that you tell as you have conversations with investors. So number one, you care because it helps you not die. Number two, it's actually how you're ultimately judged. And number three, you care about finance because it helps you focus. Focus is so critical in an early stage company. It's critical at every stage in reality, but when you are 1, 2, 3 people in a room trying to do a bunch of different things, anything that can help you focus is critical. And so if you look at your product roadmap and your strategy for how you want to go about that, and then you look at the numbers behind, okay, what expenses do I need, for example, people to build that product roadmap? And it turns out that you need $10 million and you're sitting there and you're 2 people and you haven't built anything yet. Well, it's a great time to kind of have a cycle there of go back to the strategy and rethink. And often that just means focus, de-scope, et cetera. And that's at the organizational level. It also is really critical in that it helps you focus your time as an individual. And so you need to think not just about where your company is spending time, but where you are. And so when it comes to finance, you should definitely be spending time digesting those numbers, investigating those numbers, and understanding how to affect those numbers. But you shouldn't be spending time assembling the numbers. And so that's a great case for outsourcing or getting a bookkeeper, and we can talk about that later. But the 3 general principles there again are: number 1, don't die; number 2, it's your ultimate scorecard; and number 3, use it to help you drive focus.
Yeah. I want to go back to the earlier point. So it's an echo now. When you try to put in the echo disappeared now. Perfect. So I want to go back to what you mentioned regarding number 1 job, don't die, is that I see many startups that when they reflect on when their company failed, the very, very shallow analysis they make in some cases are, we ran out of money. And the reason why I bring this up is because in many of those cases, it has nothing to do with them running out of money. It's either they did not reach product market fit or hit the numbers, or failed to communicate the opportunity of the future opportunities of the business, either internally or externally, to an investor or to a team. So I think that it sort of confirms your words regarding don't die, is that yes, I agree, but it's also important that you do a healthy, humble analysis of your own company and why things went south. The reason why, yes, of course, it's like doing a post-mortem analysis of something that died. It's like, yeah, the lungs, this patient stopped breathing. If I'm gonna make her like a medical metaphor here, the patient might have stopped breathing, and that was the reason why he or she died, right? But the real reason why he or she died was because there was a cancer tumor in the lungs, or something made them collapse and they got something through their lungs or whatever, some other dramatic stuff. which is brings me back to the main thing. Is like, then you'll not learn anything by saying, I need to be better at breathing. Like, that's not the answer. That's not the good analysis of that's not a good post-mortem analysis of your business, right? It's making sure that you keep track on those numbers and keep communicating what it makes sense for your business and have that focus. Does that make sense?
100%. I think there's a bunch of interesting things that you said there. I think reasons that startup die, I mean, you could almost abstract it to like running out of money or running out of willpower is sort of the ultimate or is sort of the output. I think of this as like inputs and outputs. Like the output of your efforts on marketing or sales is revenue, but the inputs of how you actually drive that is driving people to the site, sourcing really quality leads, a sales process, which have you. And so running out of money is sort of the output, but what are the inputs that really drove you to that? And so that's one thing. Two, let not the reason you ran out of money be because you didn't understand the basics of how your company was working. And by the way, investors pick up on that pretty quickly. Like if you don't have a general sense of the levers, so to speak, we say in finance, of what drives the business forward, that's definitely a yellow flag or a red flag to investors.
Yeah, it feels like a very, like you whenever I hear, like, because I want to learn, when I talk to founders, which companies fail, I want to learn what happened. Like, is there some learnings there? And in some senses, it might be a great opportunity to take those lessons for the next venture, right? Definitely. Put that in the backpack of experience, and then take that and get that new idea, set up a new team, use that experience, operating experience, and turn it into something good with your next company. But whenever I hear that, like, no, we ran out of money, like that's why we failed, it feels like there's no lesson learned at all in that.
Yeah. Like, was it that you didn't acquire enough customers? Was it that you spent money too quickly? I mean, really abstracted, like, finance and these things are like, how much did you bring in and how much did you put out? And so, and typically speaking, and this ultimately is true for a 2-person company and a 200,000 person company. The thing that is much more within your control is how much you spend, right? And so, because marketing is really tough. And so, like, those are the two, acquiring customers is really hard, but if you fail, like, those are basically your 2 levers. And so at a minimum, I feel like you should have a takeaway of like, well, we didn't acquire enough customers, but why? And there's this thing of like, ask like 3 whys or 5 whys to try to help get to the bottom of it. We ran out of money, but why? Well, we didn't have customers. Okay, but why? Well, we were in the wrong market, or we didn't do enough research and we didn't bring the right prototype or initial product to market and get enough traction. Okay, well, like, now you've kind of bottomed on something a little bit more interesting that we can like further dissect and learn from. Yeah.
It's sad to think about how many, like, and often that's the difference between like a first-time founder and a serial founder, where you're able to go deep and be humble about your learnings, because your failed company is not that you are a failure as a person.
Definitely not.
And it's so hard for founders to separate those things, because you're so into your passion and emotionally engaged and committed to your company that it's very hard to separate yourself from that. But I guess that's one of the main, like, takeaways for me when it comes to those companies that did not keep track on the numbers, is that, like, okay, what's the learnings here?
Yeah, and it's such a it's such a simple thing, and simple is often not easy for clarity, but it's a fairly simple thing to say, like, go find yourself. I mean, especially if you're associated with SUP 46, right? Like, there's so many resources there. Find a bookkeeper to like keep the basics under control, and spend a little bit of time. Again, SUP 46, the session we just did, have a basic cash burn forecast to generally know how much time you have left, and help that inform your strategy, which really is product roadmap and maybe hiring in the early days. And that's all that you really should be talking about. And so, finance is a really great role to play from a practical standpoint, kind of laddering up to don't die. And then certainly from a fundraising standpoint, I think in the really early days, so many of the questions initially and like your initial conversations with investors will be about non-financial measures, I call them. So it's metrics or KPIs, like tell me about your customer acquisition, engagement, and retention. Tell me about your customer acquisition costs side of things. But very, very quickly, the conversation goes to, okay, well, how much revenue, like how much money do you think you could make, right? Yep. And it gets very hand wavy, and every investor who's worth anything understands that. But what's actually really critical is that you as a founder have a viewpoint that is at least thought through, and that you can generally defend your viewpoint. It could be completely wrong. And you're sitting, Seb, you're the investor asking me, and I'm like, hey, I think my unit economics are this. I think I'll scale to Y in revenue. I can be overly ambitious or optimistic, for example. But as long as I have a well thought through process there that shows you that I have a general understanding of the business that I'm trying to build and the industry that I'm playing in, that's the checkbox, especially if you're looking for seed money or even a Series A.
Yep. And breaking down like the very, very ambitious numbers might be the thing that gets me excited as an investor. But in order to make it realistic or logically connected to reality, or whatever you want to call it, is what you just mentioned, like breaking down steps in order to reach that ambitious goal. Do you 100%. Feel like what is the biggest difference from how do you, because this is the right thing, whether it's a seed raise or a Series A raise, it's similar things, but what are the biggest difference in terms of going through those fundraising processes in terms of from a finance point of view?
Between a seed and A? Yeah. So, I mean, seed rounds and these days, even pre-seed rounds are definitely much more storytelling focused with, I would say, a definite healthy conversation around unit economics. So for every one of the unit that I sell, how much profit am I making? And loading against that like various overhead. So, in the software world, you might have, 90, 95% profit margins if you just load kind of basic AWS against that, for example. But what about your support costs and how does that scale? What about your customer acquisition costs to get sort of what I would call contribution margin? So unit economics less customer acquisition costs. That tends to be a really key piece. And then even in a seed stage, I think investors want to see a forecast. That some will ask for a 3-year. At that stage, 1 year might be okay, or 2 year. Again, I think what's most important is that you take the time to go through that, because it tells the investor that you have that understanding or don't. One, just a sort of a general business perspective, but then also of the thing that you're building and the relationships of those things. It can be a single tab in a Google sheet with mostly hard-coded numbers, or very simple, you don't have to impress anybody with your spreadsheeting here. It's more about how you talk about it to show that you understand the industry.
Yeah.
And so,
do you think? Yeah. Do you think that, like, because in many cases, when I've seen seed decks and pitch decks related to seed, those tend to be very far from talking about profit margins. It's more like the opportunities of the future. It's more like, how can I communicate? Okay, I might like if my thesis is correct, this will scale beautifully. And if this scales beautifully with smart distribution channels, then the customer acquisition cost will be automatically really low, which should, in theory, mean that I have beautiful profit margins, unless I have some very weird, like, computing requirements that cost a lot of money, but still, with scale, it should be like generate more profits.
Totally.
Does that make sense?
Yeah. Look.
So what I'm trying to get at here is like, it doesn't matter if you communicate 90% profit margins or 40% profit margins. It's like, it might obviously look more attractive with 90% profit margins, but if you hit scale, then it's gonna be a money printing machine either way. Does that make sense?
Yeah, totally. In kind of the pre-seed and seed rounds, for sure, you are mostly selling a story and a go-to-market strategy and the team, and then your prototype, if you have one. And so the finance angle of that becomes very, very back of napkin. I think still being able to talk intelligently about how do I think costs will scale to serve that revenue is important. And the other side of that is what you were saying is acquisition costs. And I think the idea that like CAC will take care of itself is an argument or a thesis that not a lot of investors are going to buy unless you really have inherent virality in the platform, like Superhuman was able to achieve, for example, or like a Facebook or a social network, because like inherently, if it grows, you are acquiring users. And so I definitely, do you need like a detailed calculation about that? Well, maybe less so in the earlier days because you're hypothesizing. But definitely like a general model of like, well, for every unit I sell or every customer that I acquire, I think I'll have an LTV of roughly this. And I think it'll cost me roughly that to acquire them. And having like a general sense of that, but acknowledging in the early days, it's totally a guess. And then even at a Series A, you absolutely will need to have a viewpoint. And when you're raising your Series A on that, absolutely, almost absolutely, depends on what you're building, of course.
Yeah.
But you'll definitely need to have a more of a view into the LTV and CAC and like contribution margin side of things. Still, a lot of the conversation focuses on other metrics for sure. But yeah, have an idea of how that scales, and then the overall value of the company and that kind of thing. You're generally more approaching from the standpoint of a total addressable market, a TAM, to say, oh, the market that I'm playing in is $100 billion. If we capture 1% of it, we'll have a great company on our hands. So
yeah, that's like the high level take on it.
Yeah, we say sort of tops down in finance, and bottoms up would be like, well, I'm selling my product for $10 a month, and that equals, I can build that up to $1 billion company.
Yeah. The differences. No, I can hear myself again from your laptop. I think the speaker's in your laptop. Okay, now it disappeared. Perfect. So another question regarding like the metrics. There are obvious differences between B2Bs and B2Cs, right? If you're a consumer-driven solution, the investors tend to have more patience with you making money than a B2B. Do you want to talk about that for a second or two?
Yeah, for sure. I mean, take like a social network. I mean, there's many examples when you're selling into consumers, in particular if you're selling services or software, where user metrics are really important in the early days. Like a social network, like it's all about gathering users. That comes from a thesis of there's a massive first mover advantage or a winner take all concept in some of these markets where like turns out there was only really one Facebook that became Facebook. There was only one Instagram. And so, you know, if investors have, for example, that kind of thesis about a market, then very much like it's about, let me just give you a lot of money to go acquire users and we're going to figure out monetization or just turn on monetization down the road. So I think recent example could certainly be Clubhouse, where they raised a ton of money. And I think they're only now starting to monetize or experiment with monetization. Because sometimes monetization's not as obvious on how it works. It's not always just throw up some display ads. So definitely on the B2C side, you see some of that. I would say though, if you are selling a physical product on the B2C side, you're going to have much more conversation around the hard numbers. Yep. And then on the
hardware
B2B,
is hard.
Sorry?
Hardware is hard.
Hardware is hard. And CPG, it can be hard. But CPG tends to be a little bit more straightforward in one sense anyway. And so on the B2B side, I think part of that is personality of investors in a way. But I think what B2B investors typically will want to see is a couple early banner customers that are hopefully paying you something, but definitely have really, really positive feedback. And there the focus tends to be, okay, well, what does the sales cycle look like?
Yep. How
long does it take you to sell into it? And if you're talking a 12-month sales cycle, that's going to be a really difficult conversation. And so, and this gets into strategy and why I kind of always think of strategy and finance as so interrelated, but how can we revisit strategy and de-scope or sort of build a module that's still useful that can get up and running and driving engagement and ideally revenue early on. And so I think that's where a lot of that bias comes from the B2B side is like, there's a lot of opportunity in the B2B space. It's just pretty challenging to go to market because you have a lot of investment upfront that's needed to like build software for, I don't know, pick a thing that's kind of boring but important, like, restaurants at a time. Like the back end of running a restaurant may seem boring, but is really important. In order to get restaurants on board, like that may have a really long sales cycle because in that case, restaurants tend to be very price sensitive, whereas large corporations tend to have very long sales cycles because they want to do RFPs and they want to do diligence and InfoSec and all this kind of stuff. So that's kind of where things come from, I think, from that.
Yeah. We got a heart from John Paval. Appreciate it from Facebook. I have another question that are like leaning towards your experience being chief of operations of Feather, which is a former YC company or YC alumni. Do you want to give us a couple of like learnings from scaling the team and that journey and how can one learn from that as a founder?
Totally. Yeah. So my role there, I was there for 3 years. The first 2 years, I split the company with the founder CEO. And in the last year, I was managing all functions of the company and was building out and then built out the executive team as well during that time period. So I joined Feather at I think I was employee number 6, and we had 2 of which were in the field. So we were very very small team in the office. And we scaled to 3 cities and 100 people, as you mentioned. And so what's important, when I joined, the seed round was in the process of closing. So really at the early stage. And we had some initial traction. And so when it comes to hiring, again, it's an output of the strategy and what you're trying to achieve. I would say on hiring, some takeaways are develop interview frameworks and hiring frameworks early. Be structured about your interviewing, and this was such a powerful learning from Stripe, right? And you know this, really having the hiring manager ultimately be responsible, and you know eventually you'll have a recruiting function, but we didn't have that. Was sort of me. What is really important about this role, and how does that ladder into strategy, and make sure that gets written in a summary form that is the job description, right? I mean, it sounds simple, but when you're like, oh my gosh, we need another person to do this, like make sure you have that. And I think the second part of that actually very often excuse me, gets overlooked, people do a job description decently sometimes, but they don't do a scorecard of sorts. And scorecards, I talk about scorecards for the company in the context of finance, but a scorecard for individuals is sort of a similar concept, less so based on maybe revenue, unless you're a salesperson, for example, but more based on driving certain metrics, hopefully. And in the very early days, it's very activity based, meaning like I rolled out a new system or a new process or what have you. And I think that is hard to do in the early days, but it's amazing. I think especially when you hire leaders in the early days, like having that scorecard to create a meeting of the minds between you as the founder and this leader of what they are looking to achieve. And you don't want to have, if it's like, you should have probably no more than 4 to 7 things on that scorecard. And of those things, all of them hopefully should not just be activity based. They should be value based or like results driven, like you're driving a particular metric forward in some way. And because if it's a leadership position, like ultimately I want to hold people accountable for driving certain results.
Do you think that the scorecard should be things that you need right now, or things that will be relevant in 12 or 24 months? Like, how should one think about that? Because a company growing from 6 to 100 people, like you go through so many different stages, and you might not know exactly what you need in a year anyways. Like, what do you think on those topics?
Yeah, 6 to 12 months. 6 to 12 months with the understanding that that's going to change, right? But again, laddering down from the company level, if we know that we want to raise money, whether it's in 6 months or whether it's in 12 months, at least for the sort of the key leaders or the key areas like customer acquisition and product, we should have a sense of some goals there. And whether or not, if it's to acquire 1,000 users or 750 users, that can change, but we know we have a user acquisition goal of some kind. And so again, even just having this conversation, because, you may not run things so kind of process oriented at a 5-person company. It may feel kind of overkill, but it's amazing that nothing creates clarity like clarity, right? Like just having that conversation and that back and forth with an understanding of trust of like, look, like we think we can get 1,000, but if we get 100, you're not just fired or something. But like, also we know we need 1,000. So like, that's where we want to kind of anchor our goals, and all of the resources and that we're going to allocate towards that.
How do you balance between structure and chaos? Because there's no, like, you can't execute processes that will be irrelevant in a month or two. Like that doesn't make any sense. It's just
Definitely not.
that would just create confusion. Like where do you stand? Let's say you got the money from the investors. You're like you have a hiring goal and you want to grow, and you know what type of roles you need and the functions that you're looking for, and so on. Like how to make sure that they are onboarded properly, and that those who already are at the company are still engaged and everyone is understanding the purpose of things.
Yeah. So I think the answer there is you invest in things that you know are not going to go away in 2 months. And so things like, what is the company strategy and vision, right? Like that should be repeated over and over again at the appropriate times. And just because you have a company strategy, you don't have to have a 20 slide deck or something with like company strategy as the title. A company strategy can be like 2 sentences, maybe with a couple, I'd love a couple metrics behind that, but
Of course.
yeah. But that's it. And you continually repeat it, or maybe every two, if you do an all hands, like do an all hands every other week, like twice a month or something, those get mentioned, right? Like, hey, how are we tracking against that? What gets measured gets managed.
Yep.
As a principle. So, I think do the things that are clearly important. I think things like a scorecard, again, it can be a draft that sort of you just have a conversation about to try to drive focus. The most important thing in the early days is that people are on the same page, right? And so what helps us get on the same page, things like communicating strategy and vision, things like communicating more hard goals, like in a scorecard, either at an individual or at a company level. Beyond that, I think you can use the general principle of what's the biggest fire or is going to clearly create the biggest fire, and put process against that, right?
Yep.
And so if that's an internal thing, if that's a customer facing thing, like that's where you should pay attention. On the subject of hiring, I think it really depends on your pace, but I would say my bias and my experience has been investing in onboarding really early pays massive dividends, because it does 2 things. Number one, it sets a tone for people who are coming in as a blank slate to your organization and your culture. Like, we have our stuff together and we expect you to have your stuff together, and we're supporting you in having your stuff together.
Yep.
Number 2, what onboarding effectively does is it gets what is probably your most expensive new line item that you've added to your P&L, to your income statement. It gets them generating benefits to the company much faster.
Yep.
Yeah, like
you start getting productive faster if you get the good onboarding experience.
Yeah, like you do not want to look over and see someone who's on their second week who's kind of doesn't really know what they should be doing, or if what they're doing matters or is going to have an impact, right? Like that is absolutely the anti-goal. And so I think the thing that even those of us who have hired hundreds of people can forget is like how much time it does take to onboard someone properly. But when that's done properly, or conversely, not done properly, how either impactful or draining that can actually be, right?
Yeah. I heard like a good hit rate. This is scary numbers, but a good hit rate in terms of good hires is 50%. So for every individual, for every headcount that you add, the next hire is going to be a bad one. What's your thinking? Do you recognize the stats on that, or?
I don't have any hard stats on that. I will say that statistic is going to vary depending on stage of the company. In a big way. In the early.
How come?
Sorry?
How come?
So in the early days, if you have, for example, your hit rate may be lower because you've underinvested in process or you're new to hiring, right?
Yeah.
Conversely, when you're later stage, your rate may be lower because people aren't as excited to come work for you. And that could be for a myriad of reasons. It could be because of the culture, how hot the company is. It could be the equity value. Who knows? I mean, we all have a million reasons.
So what I mean with the hit rate, it's not that the number of offers you send out and you have 50% acceptance rate. I'm talking about those that you hire.
Totally.
50% of those that you hire turn out to be a bad fit.
Totally. Yeah.
I heard this number.
I mean, it's an adage that you hear in sales, in hiring sales, where you hire two and one's going to work out, basically. Okay. So that's definitely, that may be where that number even comes from, but I've definitely heard that adage before. But that's very different because sales is its own specific thing. I mean, in my experience, when we follow those steps that I mentioned, that we have a general, decided upon company strategy, and we've defined the job and what makes the job a success, our hit rate is definitely above 50%, or our like retention rate, or whatever you would call it.
Yeah, retention is maybe a better.
Like ultimate retention rate, or like first 6 months retention rate, something like that. I think it's definitely higher. We have great companies, we communicate good culture, we have good funding. So there's like a bunch of other aspects there. If you're looking at like all startups, there's a lot of people out there in varying qualities and in varying approaches. And so the number strikes me as a bit high, but also not crazy.
I find it very momentum is not discussed a lot or talked about a lot. It's fantastic when you have momentum, and it's almost catastrophic if you lose that momentum, because it's almost exponential. The difficult stuff gets exponentially more easy when you have momentum, and the difficult stuff gets exponentially more difficult when you don't have momentum. I'm talking about everything from operations to investments, fundraising, to hiring, staffing, sales. Like, what's your, you've been in a couple of rocket ships, so but at least my scar tissue is telling me that the momentum is everything. Do you want to comment on that?
Yeah. So, I mean, certainly Stripe was a rocket ship. Rocket ships present their own sets of challenges, like a true hyper-growth environment. That word is overused. I think there's very few companies maybe that fall into that. I think, by the way, I think the difference between there's a difference between hyper-growth and chaos. And a lot of times we're calling what's chaos more hyper-growth, but the net effect is not dissimilar, I suppose. From a momentum perspective, I mean, look, Stripe was amazing. Feather, we had our ups and downs. I mean, it was mostly a success, right? But when momentum drops for whatever reason, I mean, I think it's critical, but I think that ladders back into the importance of communicating your mission / purpose and big picture vision for the company. And that's something that I always say. Everyone thinks, and when you look at someone else who's been successful, that is up and to the right on a graph. And the reality is that line looks like this. You know? And we all just forget that, frankly, because PR or stories that are told is just, we love to sensationalize really in either direction, whether it's success or whether it's failure. It's like the truth is always somewhere in between. And so I think this is a little bit less of a finance thing, right? But it's like, if you brought together a team who is committed to a purpose in Feather's case, into changing the furniture industry for the better of the planet, it makes those momentum drops a little less painful, right? And it gives you that. I mean, don't die being the maxim, but sort of within that is grit. Like if there's one thing that I've observed in myself and others that's most important in building a company is grit or perseverance. Like if you don't give up, you're probably not going to run out of money and you'll eventually do something, you know,
Yeah.
because you're smart enough, I guarantee it. Like people of all sorts of smartness, intelligent levels build all kinds of companies. What really separates people is like, what is your perseverance? And so, you know, you have that yourself, maybe because you're a founder and you don't want to have a failed company or you have other motivations. But when you start to build an organization, even for 10 people, 15 people, you'll start to feel that changes, like the importance of you communicating those things periodically. Hey, what we're doing is a greater purpose, or hey, what we're doing is, if what gets you and your team excited is simply, you know, disrupting an industry or something, it's more of like a business than it is a higher purpose. That's fine too. It's just more about collecting people that are all on the same page.
Yep. Do you want to? I think we're gonna end in a couple of minutes, but I just wanted to stay on that poem, that topic for a minute. Hypergrowth versus chaos. Many companies that are growing fast. Everyone has read blitzscaling. Everyone knows that concept, and many people also hiding behind not having to do not forced to do the important stuff that needs to be the foundation that needs to be built, and they're protecting themselves from doing that by saying we are accepting chaos because we need to grow so fast, versus what you're talking about is real hypergrowth. Like, do you want to help us break that down?
Well, not to sound like a broken record, or that my numbers bias coming in, but I think a lot of it for me is, how are we tracking to our big picture goals, right? So if things are chaotic, but we're moving the organization to the place that we need to be in 6, 12, 18 months. I mean, often we're thinking in fundraising cycles. That's not always the case. If you're already profitable, you can think differently. And I would think differently, certainly. But if we're thinking in those terms, are we doing the right things that matter to meet those milestones? Have we spent the time figuring out what those milestones are? If we have, then I'm okay with fires burning here and chaos there, because those are intentional. Like for sure, building a company, and the secret sort of is actually even running some companies. It's just, they're so big, you kind of don't think of it that way. But especially for startups anyway, like it's prioritization of resources and being okay with fires smoldering over there, because that you're fighting the bigger fire, or like the bigger opportunity over here. And so I think that's probably in big part what separates out chaos from hypergrowth. I think first it starts with like, are you going in the right direction? And then the second piece of that that's absolutely critical is, how are you as a leader communicating that to the organization? So we might be doing everything right, like we're Uber and we're scaling into new places or whatever, but, and this is not an example of Uber specifically, but like if Uber's team or the leadership team is not communicating, hey, these are the goals, we're tracking against them, things feel tough right now, but we know that success is here. Here's success defined, and we're working against it. I think that's a major difference. And then that turns like, I mean, look, you know, Stripe had chaotic times. There's a lot of craziness going on there. I mean, you remember, you were there in the early days too. Like, but we all knew what we were driving towards.
Yeah, for sure. I think that's good. Like, it never felt like during my time at Stripe, it never felt like we didn't know what the purpose was. So I guess that's like a good signal. So you always have that compass, the distance compass navigation star that you want to follow. I think those are great final words. Is there something else you want to send with us? Thoughts and from an experienced finance/operator.
Yeah, I think, on the subject of hard finance, I think spend a little bit of the time that you probably have been putting off or you aren't looking forward to spend getting smart in some of these basics. You don't need to be an expert, but you definitely want to be able to have these high level back of napkin conversations in the moment with investors on things like, I know what my revenue has been for the past couple months, past 3 months at least. I know what my metrics have been for the last 3 months. You get comfortable with those numbers. A great way to do that is to send out investor updates or just updates to your friends. Find a few, hopefully, that are more analytically minded who can kind of poke and ask some questions. And so that's the definition of success for you in the early stage is get comfortable with the numbers, identify the numbers that are important, have conversations with investors, and they'll give you feedback, and you can refine that.
And don't lie.
And definitely don't lie.
Never lie.
Definitely never lie. I guess needs to be said. And so that's and outsource where appropriate, right? I mean, just realize that even if you outsource, like mostly you're going to be getting assembly of numbers, and unless you really hire a part-time CFO who's going to live like really deeply understand your business and stay up to date, which is kind of expensive in the early days. Like I would bring on an advisor and give them some equity who has that skill set. But in the end, it still falls on you to be smart about those things because you are the leader. And then the second piece of that is what we were just talking about is communication of that strategy and those goals is critical, both internally to the existing team and then as you bring on more folks to get everyone centered on the right things.
Yeah. So great advice. One of my I find it really difficult with the communication part of those things because a lot of thoughts are happening in my brain, and the communication of like extrapolating all the crazy thoughts into actionable metrics or thoughts or goals or plans or KPIs or whatever you want to call it. That is actually what makes it a real group of people trying to solve a problem together. And one of my favorite leaders of that is who should I think Airbnb is a great example of what's the name of their CEO now?
Brian Chesky.
Brian Chesky, a fantastic communicator, excluding values and moral and ethics, which is obviously, at least from my perspective, very on target, but just the way he internally and externally communicates is like a really good way of keeping everyone connected towards the main goals.
Yeah, 100%. And I mean, in reality, this is sort of a whole other topic almost, but the role of a CEO at a company, even at smaller companies that are just starting to scale, has grown. Like the needs have grown. That's why hiring a COO, for example, is like every founder's first thing that they want to do once they've raised a round of equity. Because as a CEO, your job is to make sure the company doesn't die, which is a way of saying fundraising and investor relations. Your job is to set the overall strategy and vision and mission of the company, but principally where are we going to focus our resources? And your job is to communicate. And you could almost say it's those three things. In the early days, you might be writing lines of code, you might be answering support tickets, but for sure, somebody needs to do that at your company. And communicate is a big pillar within that because communication is not just internally, which is critical and is hard, and you have to productize or sort of think about how to do that. All hands, a monthly email, a Slack, whatever your channel of choice is, and then communicate that effectively to investors to get them excited and on board, and to part with their money.
Yeah.
Yeah.
Great final words, Andrew. Always good to chat. Let's catch up soon. And what's the time in New York now?
We're just about noon.
Noon. All right.
Yeah.
So have an amazing lunch. And for those who tuned in, thanks so much. I don't know why. Sorry if anyone tried to write to us through LinkedIn. It's not connected. It's not working properly. But anyways, hope it was helpful. I at least had a lot of fun. Have a great evening, everyone. Take care.
Thanks, Ed.
Thanks, Andrew. See ya.